Imagine a crisis so, mathematically certain that you can map it to the exact day.
Right, but almost no one is actually building the infrastructure to stop it.
Exactly. And today we're doing a custom deep dive just for you on a supposedly, well, a boring real estate company that looked at this rapidly aging global population, realized no one is coming to save us, and secretly morphed into an artificial intelligence giant to capitalize on it.
Yeah, and if you're thinking that analyzing a real estate investment trust or a REIT sounds like a dry exercise in property
I
taxes,
mean, I wouldn't blame you.
right, I don't blame you all. But this is actually a masterclass in corporate evolution. It's the story of a company using the single biggest demographic wave in human history, the silver economy, as a Trojan horse to rewrite its entire business model.
We're looking at a pair of totally fascinating documents from the first quarter of 2026. We've got the Q1 earnings release and the detailed investor presentation from Welltower, which is a massive S&P 500 company.
Huge player.
Okay, let's unpack this. Because before we even touch a single financial metric on Welltower's balance sheet, we really have to understand the unavoidable tectonic shift happening in the global population right now.
Yeah, you really do. Because if you don't grasp this demographic reality, literally none of the financial wizardry makes any sense. It's the bedrock of the whole narrative.
So what are we actually looking at here?
In the industry, they call it the silver tsunami. And the presentation lays out the numbers, and I mean, they are just staggering. Historically, the population of people aged 80 and older grew at a pretty steady rate.
Like what kind of rate?
A compound annual growth rate, or a CAGR, of about 1.8%. So slow, predictable growth year over year. But right now, as the massive baby boomer generation ages into this bracket, that growth rate is exploding.
Wow.
Yeah. Between 2026 and 2030, the 80-plus population in the U.S. is projected to grow at a 5.4% CAGR.
And just to clarify, when you say compound annual growth rate, we're talking about growth that builds on itself, right?
Right.
Like compound interest in a savings account?
Exactly. It's an exponential curve. So a 5.4% jump compounding every single year means we're talking about millions upon millions of people rapidly aging into a highly vulnerable phase of life.
Millions. But here's the thing. The absolute number of 80-year-olds is only half the equation. The more critical metric in this report is something called the familial caregiver ratio.
Okay, yeah, I was actually looking at that specific chart, and honestly, it confused me at first. It seems to just be dividing the number of 50-year-olds by the number of 80-year-olds. Why is this specific ratio the panic button for the entire elder care industry?
Because it measures the human safety net.
Okay.
The familial caregiver ratio looks at the pool of adults aged 45 to 64. That's the statistical sweet spot for an adult child who might care for an aging parent. And it divides that number by the number of individuals aged 80 and over.
I see. So historically, we had larger families.
Right. There were plenty of adult children to absorb the immense physical and, emotional burden of elder care. So if grandma couldn't live alone anymore, there were, 3 or 4 kids who could take her in or at least rotate checking on her.
Exactly. But factor in modern shifting demographics. You've got lower birth rates in the generations following the boomers.
Right.
You've got the reality of dual-income households where nobody is home during the day to provide care, and families are geographically scattered across the country for work.
Yeah, so true.
So when you combine those sociological realities with the sheer compounding volume of aging boomers, that caregiver ratio is just plummeting. The growth of the 80-plus cohort is vastly exceeding the available family members who can physically care for them.
Which means the traditional family safety net is mathematically breaking. Family care is simply not going to be an option for millions of people.
No, it's not. And what happens when families can't provide the care? It forces an inevitable, dramatic increase in the utilization of specialized seniors housing.
It has to.
Yeah, the demand becomes incredibly inelastic. This isn't a luxury purchase. People don't just want seniors housing. They absolutely need it for their basic survival and safety.
So we have a demand curve that is literally a biological certainty, and it's shooting straight up.
Oh.
But then the report highlights the other side of the economic seesaw, which is supply. And frankly, the supply side of this equation is shockingly constrained.
It's totally flatlined.
Yeah, the presentation shows new construction of seniors housing has basically stopped. Construction starts in the first quarter of 2026 are down 87% from their peak.
87%.
They're sitting at levels we haven't seen since the depths of the global financial crisis back in 2008.
And if you're listening to this and wondering, well, if the demand is so high, Why doesn't a developer just buy a plot of land and build a new facility right now?
Yeah, that seems like the logical move.
The answer is the timeline. The report notes it takes an average of 7 years just to take a seniors housing project from formation to stabilization.
7 years. That is a massive lag.
And that's just the average. If you are building in a high barrier to entry market, like coastal cities or affluent suburbs, it takes significantly longer.
Oh, I bet.
You have to secure the land, fight through years of local zoning board meetings, do environmental studies, deal with elevated construction and borrowing costs.
Right.
And then, after the building is finally standing, you have to recruit the human capital. Finding nurses, administrators, and specialized care staff in today's labor market is an incredibly steep hill to climb before you even break even on the project.
So it's less like organizing a sold-out concert and more like being the only seller of oxygen tanks at the summit of Mount Everest. The demand isn't a choice, it's a biological necessity, and there is almost zero chance of new competitors hiking up the mountain anytime soon.
Great analogy.
Which means the pricing power for the existing players is practically absolute.
What's fascinating here is how a broader market is absorbing this exact dynamic. You might intuitively think that if demand is surging and supply is essentially choked, prices must be spiraling out of control to the point where seniors are completely priced out.
Right, that's what you'd expect.
But the data Welltower provides shows something entirely counterintuitive. Despite these intense upward pressures on price, seniors' housing affordability has actually improved 4.4 times since 2008.
Wait, how is that possible? Prices are going up, but it's more affordable.
It comes down to generational wealth accumulation. The older age cohort, the silent generation, and the older boomers entering these facilities, they currently hold somewhere around $80 to $90 trillion in wealth.
90 trillion. Wow.
Yeah, and much of that is tied up in their own home equity, which has skyrocketed over the last few decades. So while the monthly rent for seniors housing is high, the wealth transfer and asset appreciation of the customer base means the market can easily bear higher rates without breaking the consumer.
Okay, so they have this severely constrained supply, skyrocketing in inelastic demand, and a customer base sitting on trillions in home equity. This effectively hands Welltower an immense, almost unprecedented amount of pricing power.
Exactly.
Let's look at what happens to a balance sheet when a company can practically set its own prices, because this leads directly into their Q1 2026 financial results.
Yeah, the financial flex here is historic. Welltower just posted their 14th consecutive quarter of 20% plus net operating income, or NOI, growth in their seniors housing operating portfolio.
And just to clarify for everyone, NOI is basically the cash a property generates after subtracting all the daily operating expenses before you pay the mortgage or taxes.
Spot on. And in Q1 2026 alone, that growth hit 22.1%. And their overall same-store revenue grew 9.5%, driven by a massive 370 basis point jump in occupancy year over year.
So 370 basis points, which in plain English means their occupancy rate went up by 3.7%. When you're managing tens of thousands of units across the globe, a 3.7% jump means thousands of new paying residents. So what does this all mean? I have to push back a little here.
Sure.
When I see consecutive quarters of 20% profit growth in a business dealing with vulnerable seniors, my immediate question is, are they just squeezing these people with significantly higher rent every year? Or is there actual business efficiency happening underneath the hood?
That is the exact right question to ask.
Yeah.
And the unit economics outlined in the presentation tell the real story of how they are achieving this. Yes, they are raising rents, what they call revenue per occupied room, or RevDOR.
Okay.
That grew by 5%, so that reflects the healthy pricing power we just talked about. But the true operational magic is on the expense side of the ledger. Their expense per occupied room, or XPOR, only grew by 0.4%.
Wait, their expenses per resident basically stayed flat while their revenue went up 5%. How do you keep expenses at less than 0.5% growth in this crazy inflationary environment?
It's wild, right? The report explicitly notes this is one of the lowest expense growths in the company's recorded history, and that's spread. The difference between the 5% revenue growth and the 0.4% expense growth created a massive 320 basis points of margin expansion.
Meaning their pure profit margins widened by 3.2%.
Exactly. What we're seeing is the beautiful reality of operational leverage in commercial real estate.
Break that down for me. How does operational leverage actually work in a seniors housing building?
Well, think about the fixed costs of a massive building. whether a facility is 80% full or 90% full, your major expenses don't really change.
Oh, right. Property taxes are the same.
The property taxes are the same, the mortgage payment is the same, the costs to heat the building, light the hallways, employ the core nursing and administrative staff, that remains largely static.
Got it.
So when that occupancy rate jumps up by that 3.7% we mentioned earlier, almost every single extra dollar of rent from those new residents drops straight to the bottom line as profit because the fixed costs are already covered.
Okay, that makes perfect sense. So they are generating an absolute mountain of cash right now. But what really jumped out at me in the docs is that they aren't just hoarding this money or sitting still.
Not at all.
With margins that wide and cash piling up, they face a massive capital allocation question. And they are playing incredibly aggressive offense. The sources show they announced $10.5 billion in year-to-date investment activity.
A huge number.
And that includes a 4.1 billion Canadian dollar acquisition of 38 high-quality Amica communities up in Canada. They are buying the absolute best assets on the market right when nobody else can afford to build new ones.
And they are doing it from a fortress balance sheet.
Mm.
Even with all that aggressive buying, their net debt to adjusted EBITDA sits at a historic low of 2.7x.
Let's translate that for you guys listening. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically a measure of raw operating profit before the accountants and tax lawyers get their hands on it.
Right.
So a 2.7x ratio means their total debt is only 2.7 times what they make in pure operating profit in a single year.
Precisely. In the highly leveraged world of commercial real estate, where companies often carry debt loads of 5 or 6 times their earnings, 2.7x is almost unheard of.
It's incredibly low.
It means they have immense financial flexibility. They are generating so much free cash flow that the report shows they actually paid off $700 million in unsecured notes at maturity using just cash on hand.
Wow.
Yeah, in an environment with elevated interest rates, they didn't have to go to the bank and refinance that debt at a higher cost. They just wrote a check, eliminated the debt entirely, and moved on. It's a masterclass in capital allocation.
Which brings us to the pivot point of this entire deep dive. Because if the story ended here, it would just be a solid case study of a traditional real estate company managing supply and demand really well.
Sure.
But Welltower's leadership isn't just buying more bricks and mortar. They are taking this immense cash flow and essentially rewriting their corporate DNA to enter a phase they're calling Welltower 3.0.
Yeah, that's their term for it.
And the presentation includes a quote from the CEO's 2025 shareholder letter that I found fascinating. He uses the phrase burning the boats.
It's a powerful historical metaphor. When a commander lands his army on hostile shores and orders his men to burn their own boats, it signals that retreat is literally impossible. The only way out is forward.
Right, there's no going back.
For Welltower, this signifies a total, uncompromising commitment to operational and technological transformation. They aren't just dipping their toes into technology, they're leaving behind the traditional way of doing real estate and going all in.
He also pairs that burning the boats concept with another really vivid analogy, the hummingbird strategy.
The hummingbird is a brilliant way to frame disruptive innovation. You know, a hummingbird doesn't fly by just flapping its wings up and down a little bit faster than a pigeon or a hawk. It has evolved a completely different anatomical mechanism. Its wings move in a figure-8 pattern, generating lift on both the upstroke and the downstroke, which allows it to hover and even fly backward. The CEO's point here is that superior outcomes don't come from doing the exact same things as your competitors, just incrementally better. True outsized returns come from doing things fundamentally differently.
Okay, I love the analogy, but I have to put my skeptic hat on for a second.
Go for it.
I'm looking at how they describe themselves in this presentation. They call Welltower an operating company in a real estate wrapper. Honestly, my BS detector goes off a little bit. Every modern company claims to be a tech company now to try and get a higher stock valuation. What makes this more than just putting an iPad in the lobby and calling it digital transformation?
That isn't entirely fair. Skepticism, I mean, we see that all the time. But the distinction here is what they call the TAM, the total addressable market. For decades, the $400 trillion global real estate industry has been largely tech poor.
Yeah, that's true.
It's an unscalable, highly fragmented business, traditionally driven by local relationships, gut instincts, and golf course handshakes. Welltower recognized this massive TAM and realized that if they could inject actual predictive data science into it, they could disrupt the world's largest asset class. They want to be TAM-rich and tech-rich.
But you can't just decree that you have a tech culture now. You need the human capital to actually build the infrastructure. And this is where they executed what looks like a surgical strike on the talent market.
They absolutely did.
The presentation outlines this executive group they've assembled called the Tech Quad.
Yeah, if you want to operationalize real estate with technology, you look for the people who've already successfully done it. And ironically, no sector has optimized its operations quite like the self-storage industry.
Self-storage? Really?
Yeah. So Welltower poached top talent to lead this charge. They brought in Jeff Stott as their chief technology officer, who was formerly the senior VP of technology at Extra Space Storage. And Stott immediately brought over his former colleague and Extra Space CTO, Braun McCall, to head up enterprise systems integration.
So they grabbed the guys who figured out how to perfectly optimize thousands of metal boxes and brought them in to optimize seniors' housing. How does self-storage tech map onto elder care?
Well, think about what makes a modern self-storage company profitable. It's fully dynamic pricing models that change by the hour based on local demand. It's sophisticated digital lead generation, automated facility management, and using sensor data to predict maintenance before something breaks.
Oh, I see.
Welltower is taking that exact digital playbook, the software side of things, and applying it to the highly fragmented hardware of seniors' housing.
And it's not just the Extra Space guys making up this tech quad, right?
Yeah, correct. It's a four-pronged attack.
Oh.
Alongside Stott and the McCall, they have Swagat Banerjee serving as their chief data officer. He has spent a decade quietly building out Welltower's internal machine learning platforms.
Okay.
And finally, they added Logan Grizel as Chief Innovation Officer to drive these strategic initiatives across the entire portfolio. This isn't an IT support desk. This is a heavy-hitting tech executive team designed to completely fuse the physical real estate with predictive software.
Here's where it gets really interesting. They spent a decade building this incredible internal data and machine learning tool just to figure out which micromarkets they should buy buildings in and how to perfectly price their own units.
Right.
But they realized the software was actually world-class, and now, according to this Q1 report, they are licensing it to other companies.
Yeah.
When I read that, it hit me. This is exactly the playbook Amazon used to create AWS, Amazon Web Services.
It really is.
Amazon built massive server infrastructure just to keep their own retail website running during the holidays. Then they realized, wait, we built the best cloud system on Earth. Let's just rent the extra space to everyone else.
It is the exact same evolutionary leap, and it represents a massive paradigm shift for a real estate company. The Q1 2026 release details these first-of-their-kind data science partnerships. Welltower is officially licensing its bespoke, supervised and unsupervised machine learning models to outside players.
Let's break down those terms for a second because, machine learning gets thrown around a lot. What is the difference between supervised and unsupervised models in this context?
Sure. Supervised learning is when you give an AI system a bunch of labeled examples. You might say, here is data on 50 highly successful medical clinics, and here is data on 50 failed clinics. Learn the difference. The AI then uses that criteria to evaluate new locations.
Okay, that makes sense. And unsupervised?
Unsupervised learning is wilder. That's when you feed the AI a massive mountain of raw, unlabeled data and just say, find the hidden patterns. It spots correlations that a human analyst would never see, like maybe a connection between the number of left-hand turn lanes in a zip code and the long-term viability of a physical therapy center.
That is fascinating. And they aren't just testing this with small startups. The report explicitly mentions they are partnering with Public Storage, which is another massive S&P 500 company, and a preeminent $60 billion private equity firm.
If we connect this to the bigger picture, the strategy is brilliant. The private equity partner is utilizing Welltower's predictive models specifically for outpatient medical site selection and tenant identification.
How does the AI actually do that? Like, how does code on a screen know where to build a doctor's office?
It layers thousands of disparate data sets. It tracks anonymized cell phone traffic patterns to see how people actually move through a neighborhood. It analyzes local zoning laws, the hyper-specific age demographics of a zip code down to the city block, and even Medicare billing data to see exactly what kind of procedures are being performed nearby.
Oh, wow. That's incredibly granular.
Yeah, and the AI synthesizes all of this to predict with incredibly high accuracy where a new medical clinic will thrive and precisely which medical specialties are most needed in that specific building.
So it gives this $60 billion private equity firm an asymmetric information advantage. It drastically increases their speed to market. Instead of a team of human analysts spending 6 months debating if a corner lot is a good investment, investment, the algorithm tells them instantly with higher accuracy.
Exactly. And for Welltower, this is pure high-margin upside. It's the capital-light business expansion.
Right.
To make this money, they don't have to buy a physical piece of land, they don't have to secure a mortgage, and they don't have to hire a single nurse or janitor. They're just renting out their brain. It gives them a whole new software-as-a-service revenue stream that has infinite duration and practically zero marginal cost to replicate.
It is the ultimate execution of that hummingbird strategy. They took the immense cash flow generated by an unavoidable demographic wave, the silver tsunami, and instead of just lazily buying more buildings, they invested in a completely different capability.
Yeah, they really did.
They are achieving what their CEO calls compounding at a discount. They get the highly predictable, inflation-protected cash flows of being a physical landlord married to the infinite scaling, high-margin revenue profile of a Silicon Valley tech company.
And that combination of hardware and software is what creates a truly unassailable competitive moat.
It is wild to see it laid out like this. So let's summarize this journey. We started this deep dive looking at a demographic reality that is absolute. The 80-plus population is exploding globally, while the family members historically available to care for them are vanishing due to shifting modern lifestyles.
Yep.
We watched how Welltower used that intense supply and demand imbalance to gain immense pricing power, creating huge profit margins because of fixed cost operational leverage. But the real revelation is that they didn't just act like a traditional landlord.
Not at all.
They used that cash to burn the boats. They built a vertically integrated model, assembling a tech quad from the self-storage industry to combine their physical real estate with predictive software. And now they are literally licensing their AI to multi-billion-dollar private equity firms.
Which is a transition very few legacy companies ever successfully navigate. And this raises an important question for you to consider long after this is over. If an aging, supposedly boring real estate REIT can successfully pivot into licensing predictive AI data models to $60 billion private equity firms. Sorry, let me rephrase that.
Go ahead.
If they can pivot into licensing these predictive models to massive private equity firms, what other seemingly sleepy traditional industries out there are sitting on proprietary data gold mines?
Oh, that's a great point.
Who else might be secretly building the stealth tech giants of tomorrow while everyone else is just looking at their physical assets?
That is the perfect thought to leave on. Thank you for joining us on this custom deep dive. Keep questioning the surface-level narratives of the businesses around you. Keep looking for those hidden hummingbird strategies, and we'll catch you on the next deep dive.